And welcome back, Lenska Realty with another San Diego real estate market update, August 2020. It certainly has been a hot and sizzling summer. We will discover what's so hot and sizzling about the real estate market. I also serve on the board of SDCIA, the largest investor club in Southern California. And here's my resume. I appreciate your referrals. So call me when you have your you need some professional help on your real estate transactions. And I always advise people on fix and flips and other broker price opinions. You can also find many more events on my meetup site. And if you like it, then you should have put an offer on it. There are deals out there right now. Here we go. I know there are lots of opinions, and including obviously mine. I'm not selling any apps or programs or courses, so this is purely educational. I look at data, history, and demographics, and I present data, graphs, and analyzing things to help your bottom line. So definitely there will be no fortune teller. I'm only interested in helping you build your fortune, and with that, your real estate fortune. So to get into it, do we have a V recovery or not in our future? So far, we have seen some V recovery in some of the parts of the economy, but not in all of the economy. It looks like the general public thinks the economy is not doing too well, as after the steep decline in April and then a small recovery in May and June, we actually in July see a drop. So we know that the tech market and all the big FANG stock had a great run-up, but we still have obviously winners and losers in this economy, and also maybe the $600 people went more into the stock market, but still a lot of worries amongst consumers. And they're right. We obviously had the most horrible number in GDP decline, which is analyzed a 32.9% decline in the second quarter of 2020. But year over year, which was a much better number to look at, we had a change in about minus 9.2%. So if you look at that graph, the decline of the real annual GDP. So this was still the worst quarterly change in real GDP during the Great Recession, was minus 0.84% annualized in the quarter of 2008. The worst year-over-year change in real change during the Great Recession was only minus 3.9% in the second quarter of 2009. So it's horrible, and how do we get out of it is the question. With more stimulus, or will real estate catapult us out? But before we look at all this, we take a quick look at the global health crisis the coronavirus has created, and where the virus sends people to the hospital. So we see these hotspots in Texas, in Miami, or should say Florida, and we have a big increase in Imperial County, but San Diego so far is doing fairly well. Are we? So here's the situation, the COVID-19, the health crisis in California. We have a total cases of 560. We have about 10,000 deaths, which averages to 178 per day. So cases are one thing, obviously death and hospitalization is another. So when we're looking at the daily test, we kind of leveled out, actually dipped, okay? Then the daily, because the daily cases were on a decline, we had an increase since June in the hospitalization, but dropped in July and August, but that increase in June and July led to more daily death in August and July and August. So much is depending on the coronavirus and the Fed stimulus package right now, which is in Washington. And the Americans are being used as a political pawn in their negotiations, while the food lines and still unemployment is high. So hopefully Washington gets their act together, but we're looking at the real estate data points, sales and inventory numbers, interest rate, employment data, the HPSI by Fannie Mae, home builder sentiment, evictions, foreclosures, and forbearance. How did the real estate market fare in July? We have great news. The median home price increased 10.9% to $635,000. And actually, if you can see here on the right-hand side, this is not a V recovery. This is an I recovery, straight up, I would say. So, which had an increase of 11.5% in the median detached home price and a 7.4% increase in the attached to $467,000. So data on market, it was still moving very quickly. Pending sales were up 23.7%. Sold listings year over year were kind of even, and the price per square foot was about $430, which is an 8% increase. So just to know that number, that in July 2019, the median home price was $587,900. So overall, a very strong increasing market. So just to give you some good news, if you did buy on the last bottom of the market in 2009 or 2012 or anywhere in between, your price for your house has doubled in the last 8 years. What inventory actually helped increase the median home price? And if we look under the $1 million, it was 5.7%. Between $1 million and $2 million, it didn't increase much. It held steady, which is kind of also good news. But the $2 million to $3 million had also 5.5% increase. And we saw a lot of inventory being taken off the market in that price range when the crisis started. So these people have put their houses on the market again, and also obviously they are selling, right? And that helped the median home price to increase. Pendings were skyrocketing since April, and we only had 1,800 units in April pending, and now to 4,100 in July, which is about a 23.7% increase. Here at the bottom was the lowest, which we usually only see in December. So that's why I said our summer and fall will be the new spring sales season. The detached and all this hotness in the San Diego real estate market is obviously due to the low inventory. So our inventory is down over 50% year over year. And you guys can see the red circle here. That is where we were last year. But usually we see many more listings in the summer months. But still, we did to manage to be even with the closed sales. So that tells you that there is tremendous pent-up demand and multiple offers. The attached inventory is a little bit different. It is kind of leveling off. We had year over year kind of the June to July leveled off in inventory, and we're only down 30% in detached inventory, which puts us at 1.7 months of inventory. That is kind of the forecast looking at the pendings. So which puts us into a seller's market. And also it is important to see what is the average percent of an original list price to the closing price, to the sales price, which is very close to 100%. It's 99.8%. And it is up from last month's 1.1 year over year, 1.1%, and up from last month. So we're going up and up and up. Now, just to give you an idea, in Oceanside, 30% of the homes sold above list price. So you can see in Oceanside it's over 100%. Where in Rancho Santa Fe, you could see, say, nearly a 10% below the asking price. And remember, Oceanside sells within 2 weeks, and Rancho Santa Fe sells in 2 months, as there is really an increased inventory, and that shows you how increased inventory can put some price pressure on the sales. And so we have bidding wars everywhere, right? So Oceanside, every decent home has about 10 to 15 offers in, and I'm not talking investor offer, not fix and flip. But if you do find a fix and flip, you'd be guaranteed to sell it quickly, which can make a huge difference to your bottom line. So Redfin says 20% of the winning home offers waived the inspection contingency in June, up from 13% last year. So definitely waive the appraisal contingency, as appraisers cannot keep up with the price increase. I know we're pushing the comms, and there's again tremendous pressure from the appraisers to first of all get out there quick, because sellers don't want to wait. They want to have the contingency and home inspections and appraisal contingency signed off at least within the 14 days. Okay, so new buyers or first-time home buyers have to learn very quickly, and it's super important for them to work with a pro because of the shortened contingencies lines and also how to get their offers accepted. And even our famous friend Bruce Norris is giving a non-prediction. He says, before I make a prediction about real estate prices, I'd like to see the outcome and view the process in the next 100 days. So he's talking about the elections. I'm hoping it paints a picture of a bright future for America, but I have concerns. Yes, we see right now the post-crisis or the urgency of buying a home, as the home is becoming your new office, lifeboat, gym, family get-together. Your backyard becomes your vacation spot. So I consider your house becoming the new toilet paper. But will it last? And will it last? And will the low mortgage interest rates last? Currently, we're at 2.875 for a 30-year fixed, and if you're a VA, by all the power to you, it's 2.75. I believe that even dropped to 2.5 in the last day. So these are just as when I put this presentation together. So check with your mortgage brokers about your current rates. But all is good news, but we have to get a dose of reality. So let's look at the employment data. The July jobs report was that we added 1.8 million jobs, and the unemployment rate dropped to 10.2%. Okay, But wait, are they counting the nearly 13 million that received the pandemic unemployment assistance? This is the special program for business owners, self-employed, independent contractors, or gig workers not receiving any other unemployment insurance. A better way to assess the labor market is really to look at the labor participation rate, which is, if you can follow that line, right about 1976. So if we look between currently being at like 60 and where we used to have an average of 67.5, so that translates more to translates to having less people, about 30-40 million in the labor force. And also a better number to look at is the U6 unemployment, which is currently at 16.5, because it does count the total unemployed plus all marginally attached workers plus the total employed part-time for economic reasons. In the 30s, we had long lines, and now we have long lines for food drives. Over 1,000 families lined up and continue to line up. So I think the more realistic number, considering everybody, self-employed, unemployed, fell off the unemployment list, and maybe some of the furloughed workers that haven't decided to file unemployment, is probably closer to 20%. Even so, last week we had the first time initial claims under 1 million. So, but that's no reason to celebrate, because we had 50 million and counting in the past. And also there are less job openings, and that was from Indeed, about 25%. Let's see how Americans feel about the housing market. Fannie Mae does a survey every month, which is called the HPSI index, and they ask people, is it a good time to buy and sell, and what will mortgage rates and home prices do, and how do you feel about your job and income? And to no surprise, as we've seen the consumer index fall, we also seen the HPSI fall about 2.3 points to 74.2 in July, which means declining slightly after increasing for the past 2 months. And just to show you in history, in August 2013, it was the last time we hit the 74.2%. Year over year, the HPSI is down nearly 20%. It's all national. If you see that number and you see how the market performs here in San Diego, that tells you, listen to your local realist instead of to national news. So buying conditions certainly have decreased, and selling conditions are slightly up month over month, but still down 47%. So I assume people now are fixing up. If you're waking up in the morning and you're working from home in your neighbor's yards, you hear jackhammering and drilling and sawing. This is kind of what I wake up. So I know people are spending money at Home Depot and Lowe's. So you can see the lines out there too if you're going to Office Depot. Also, still, the job concerns, that's no surprise. It has increased month over month just a little bit, but compared to last year, it's still like 1/3 or 28% change. And then no surprise is that there's a negative outlook for the household income month over month. and year over year. And remember, this is the number I'm looking for, that income is increasing, and all we have seen is the stimulus, which certainly has helped the Walmart, Amazon, and also people not spending it on vacations, so they're saving it. So job loss concern, people not worried about their job, 53% today versus 73% before February, before the crisis. So a lot of uncertainty. And to add, we have about 132,000 businesses closed so far from March 1st to July 10, as this graphic shows that some of the temporary closures are not so temporary, they're permanent closures, and right now we're at 78,000 permanently closed, and this is increasing. But we all heard the home builder confidence is back where it was before the crisis, led by low inventory, great low interest rate, and consumer demand for housing, and not just for entry level, also for now move-up buyers, because we realized we need an office, we need more room. We may probably, the open floor concept is taking a little step back, as master bedrooms now being converted to maybe a second office. But pressure on inventory will continue, as in Southern California the building permits took a dip in the last month. And here we still have a eviction moratorium, and which is going to be extended because 32% said they did only a partial payment or no payment. So that's a pretty large number. And just to give you a historical perspective, 1 million evictions per year, which means 1 in 40 renters were evicted. The median gross rent grew from $384 in 1950 to $1,086 in 2018, where the median household income in the US only increased 30%. And you guys can see that the real average household income is not created equal, and that's where we see the inequality in the haves and have-nots. So the top 5 making over 416,000 had quite a nice run-up, right? Where the 230,000 is kind of a slight increase, but everybody underneath did not see their income or wealth increase. So we're always asking ourselves, where are the hotspots in where renters are worried about evictions? And California is about 37%, where Washington and Utah and Vermont are faring better, but Florida, look at that, 51%, Mississippi, Louisiana, Tennessee are over 50%. So I'm always saying, if people say we have an unemployment of 10%, so why do we have 40% of renters now at risk of eviction? So these numbers kind of don't make sense. So we know we need to wait a little bit before we probably see how the real economy plays out. Okay, so 11 million households are at risk of being evicted. In San Diego County, right now, the region has several overlapping moratoriums placed on possible evictions, but many of them have already expired and are set to expire within weeks. So the eviction moratorium for the unincorporated areas in San Diego County expired on July 1st. The City of San Diego's moratorium expires on September 30th. With renters allowed to make repayments until December 30th. So we did the San Diego Judicial Council met on August 14th, and we will get an update in one of my next episodes what happens if anything changed and if the courts are willing to open up so evictions can proceed. We still have 7.7 mortgages in forbearance. The curve has in the FHA and VA by nearly 12%, where the Fannie and Freddie at 5.7 and the others at 8.2. But still, these are 4.1 million mortgages in forbearance because people, they lost their job, right? They need to make a decision what to pay. And if you do have the option of having your mortgage payment deferred, which means this lets homeowners add the payments at the end of the mortgage or something, whatever the lender decides or you negotiate, but they otherwise would be considered delinquent. And speaking of delinquent, as we've seen, since lenders can file for foreclosures, the 90 days delinquency rate is shooting up, or I should say overall delinquency is now at 7.5%, and that is nationally. So here is a look at the 30 days or 90 days. It's all stuck in a bottleneck. And if we are looking at the number of properties that are 90 days or past dues, but not in foreclosure because they can't be in foreclosure, right? We have seen this tremendous increase here where we say that properties in foreclosure is actually down. So, which means that the lenders simply ignore right now reality on their balance sheets, and unfortunately, the alternative is foreclosure and eviction. But leaving a family homeless and a lender with the property, it might not be able to resell. So nothing is easy really about this market, but pretending we don't have a problem is not really a good response. So what's the takeaway of this edition of the market update? Practically, without the Fed and the stimulus, the economy would do worse. So we are still on life support, or should I say the entire US economy is essentially on welfare. The coronavirus's resurgences globally has an impact on GDP, Great Depression unemployment levels, eviction and election cliff is approaching, and so much is depending on the outcome. We see some of the data we're looking at is not giving us the true picture of the economy, which means garbage in and garbage out. But the highlight is the San Diego real estate market with low inventory and interest rates make housing the bright spot in this crisis. And wait, there is more. If you do like to know where the latest hottest markets are and where you might find deals, join us at our Money Making Monday Zoom call. You can find it on Meetup at San Diego Real Estate Profit Building. Or you can join us for our real estate investing field trip going on nearly 12 years, where we evaluate and analyze real estate investments for maximum profit. The next event is September 19th. Fix and flip, 5 most profitable deals, and it repeats every third Saturday of each month, and you also find it on Meetup. And check stcia.com for many other events, or join the membership, because membership has its privileges, and especially if you're interested in learning more about real estate.
What if one hot
for listening. I appreciate it this month, and hopefully every time I release a video, please hit the like button, don't forget to subscribe. As always, invested in you and trying to help your bottom line.